When we study more than a century of American finance, from the railroad booms of the late 1800s to the tech-driven markets of today, we find something strikingly consistent. Markets rise and fall in patterns. Economists call these patterns financial cycles, a sequence that moves from expansion to peak, from correction to renewal. While the pace and scale vary, the structure repeats with almost mathematical regularity, much like the business cycle itself. Across the 20th and 21st centuries, the United States has lived through several defining cycles. The Roaring Twenties, with rapid credit growth and soaring equity valuations, collapsed into the crash of 1929. The inflationary spiral of the 1970s reshaped monetary policy for an entire generation. The dot-com bubble of 2000 showed how innovation can fuel speculation, while the housing boom of the early 2000s revealed how leverage, when applied to an asset owned by nearly every household, can destabilize the entire financial system. Each era looked different from the outside, yet the internal mechanics were familiar. At the core of these cycles lies a simple but powerful engine: credit expansion supported by optimistic investor psychology. When credit is cheap and plentiful, leverage rises. Investors extrapolate the recent past into the future, valuations stretch, and the fear of missing out overrides caution. Markets drift away from fundamentals, not because investors are irrational, but because incentives reward risk-taking during the expansion phase. Monetary policy often accelerates these patterns. Extended periods of low interest rates encourage borrowing, asset inflation, and speculative behavior. When inflation rises or the economy shows signs of overheating, the Federal Reserve tightens policy. Historically, this tightening phase closely aligns with the beginning of cycle reversals. The interplay between liquidity and valuation becomes the key force shaping each market era.
Behavioral finance helps explain why these cycles persist. Despite new technologies, greater data access, and increasingly sophisticated investors, human psychology has not evolved at the same pace as financial markets. Overconfidence at peaks, panic at bottoms, and the tendency to chase performance remain observable across generations. Even institutional investors, pension funds, hedge funds, and major banks exhibit predictable behavioral shifts as conditions change. To study the cycles, analysts rely on a broad set of indicators. Valuation metrics such as CAPE ratios, credit spreads, and system-wide leverage offer clues about market temperature. Yield curve inversions have historically preceded recessions. Slowing earnings growth and liquidity contraction often emerge before downturns are visible to the public. Sector dispersion, where a few industries soar while others weaken, can signal the late stage of an expansion. When comparing historical cycles to present conditions, the parallels are always revealing. Leverage levels, equity valuations, monetary policy constraints, and credit dynamics today can be evaluated against the patterns of past decades. These comparisons do not provide exact predictions, but they do highlight recurring structures that shape market outcomes. Financial cycles are therefore not random. They are the result of the repeated interactions between policy, credit, valuation, and human behavior. By recognizing these patterns, it becomes possible to identify the transition phase, the moment when the cycle quietly begins to turn and institutional capital adjusts long before the public notices. Understanding that subtle shift forms the foundation for analyzing the next stage of the sequence. In every major U.S. market cycle, from the dot-com peak to the housing boom of the 2000s, there is always a subtle moment when the tide begins to turn. It rarely arrives with breaking headlines. Instead, it shows up quietly in the behavior of the largest and most sophisticated institutions in the country. At the peak of a cycle, institutional portfolios begin to shift in ways the public rarely notices. Large asset managers trim exposure to equities,
rotate into defensive sectors, and raise liquidity even as indexes continue climbing. These adjustments are not driven by fear, but by data, balance sheet stress, tightening credit conditions, and the early signals of slowing growth. The public sees new highs. Institutions see fragility. Insider activity reinforces this pattern. Historically, insider selling accelerates near cyclical tops, just as corporate buybacks start to slow. Buybacks often flourish during easy money periods, but once financing costs rise and credit markets tighten, companies pull back. This reduction in buybacks has preceded nearly every major U.S. market correction since the 1980s. The behavioral divide between individuals and institutions becomes most visible in this phase. Retail investors tend to buy aggressively near the top, encouraged by recent gains and strong media narratives. Institutions, however, are studying liquidity flows, earnings revisions, and tightening lending standards. Smart money flows begin to exit risk assets, while inflows from small investors surge, an imbalance that has historically marked turning points. Macro data reinforces the shift. GDP growth cools, profit margins contract, and credit standards tighten across banks surveyed by the Federal Reserve. As borrowing costs rise, valuation multiples compress, sending early tremors through sectors most sensitive to capital costs. The bond market issues some of the earliest and clearest warnings. An inverted yield curve, one of the most consistent recession indicators in American history, emerges. Credit spreads widen, reflecting heightened concern over corporate defaults. Liquidity in key bond markets becomes thinner, signaling caution among primary dealers. Research institutions adjust their forecasts as well. Analysts downgrade earnings projections, highlight rising credit risks, and recalibrate models for slower economic activity. Wall Street sentiment indicators begin to soften, even as major equity indexes remain elevated. Capital flows confirm the transition. Money moves out of equities and into treasury bills, money market funds, and short-duration instruments. Defensive ETFs attract inflows. Companies build cash reserves instead of pursuing aggressive expansion. IPO and SPAC markets freeze, reflecting a shift away from risk appetite. What makes this phase elusive is that the broader public typically sees none of this. Markets may still appear strong, economic headlines may remain positive, but beneath the surface, the cycle has already begun its turn. Just as it did in the late 1990s, in 2007, and again in 2019. Once enough of these signals converge, the system enters its next stage, the period when vulnerabilities stop hiding in data and start appearing in the real economy. That is when the stress phase begins. Every financial cycle in the United States eventually reaches a moment when stress spreads through the system. Not all at once, but sector by sector. History shows that the pressure rarely begins at the center. Instead, it builds first where leverage is highest and balance sheets are most fragile. Across a century of U.S. market data, the same groups appear vulnerable in each downturn. Highly levered sectors, banking, real estate, consumer credit, and fast-growth technology firms tend to show strain early. Their dependence on short-term funding, refinancing windows, or continued investor optimism makes them sensitive to abrupt changes in credit conditions. When interest rates rise, the effects cascade unevenly. Firms with significant debt maturing within a year face immediate stress as refinancing costs jump. Mortgage-linked assets and commercial real estate feel the impact almost instantly, with valuations falling as cap rates adjust. Even companies celebrated for innovation struggle when higher rates shrink the pool of available risk capital. In every cycle, the problem isn't just the cost of borrowing. It's the sudden shift in how lenders assess risk.
Credit conditions reveal the mounting tension before equity markets do. Widening credit spreads signal that lenders are demanding more compensation for default risk. Liquidity fades in key markets such as repos and commercial paper, putting pressure on regional banks and shadow banking institutions. Historically, these are the first alarms that the system is entering a stress phase. Regional banks react in predictable fashion. They reduce lending, tighten underwriting standards, and increase loan loss reserves. This restricts credit to small and mid-sized businesses, firms that form the backbone of American employment. Many past bank failures, from the savings and loan crisis in the 1980s to failures during the 2008 meltdown, began with this subtle tightening. Certain industries depend on continual refinancing cycles, and their vulnerability becomes obvious when interest rates rise. Commercial real estate must frequently roll its debt, and growth-stage tech companies rely on equity or debt injections to continue operating. When capital becomes scarce, stress accelerates quickly. As the cycle deteriorates, defaults and bankruptcies follow a consistent timeline, typically rising 12 to 18 months after the Federal Reserve begins tightening policy. Each era exposes a different structural weak point in the U.S. economy. Corporate debt in the 1980s, technology valuations in 2000, securitized housing in 2008, travel and energy in 2020. Contagion spreads through interconnected credit channels. Weakness in banking moves to corporate debt, then to household credit. Hedge funds can amplify the volatility. Some unwind positions rapidly under margin pressure, while others exploit dislocations, increasing short-term turbulence. American history is filled with sector-level collapses that became national turning points. When these vulnerabilities surface, the groundwork is set for policy intervention. Stress marks the moment when markets stop relying on momentum and start depending on the Federal Reserve and Treasury to stabilize the system. When a financial cycle in the United States enters its descent, the shift is rarely dramatic at first. Instead, it often begins quietly, through tightening credit conditions that show up in surveys like the Senior Loan Officer Opinion Survey. Lending standards stiffen, funding becomes more selective, and liquidity that once flowed freely into risk assets begins to retreat. This is typically the moment when the underlying structure of the cycle starts to crack. Inside the Federal Reserve, economists and policymakers watch early stress signals, repo market pressures, widening credit spreads, and strains in funding markets. Even before any formal rate cuts or announcements, the Fed often signals readiness to intervene. Historically, this phase has been marked by internal evaluations of contagion risk, a pattern seen repeatedly from the 1970s recession to the 2020 liquidity shock. Once the descent phase deepens, emergency measures follow. The Fed may reduce interest rates to stabilize short-term funding and deploy lending facilities modeled after those used in 2008 or revived in 2020. When liquidity dries up across critical markets, the central bank can turn to balance sheet expansion, quantitative easing, to keep credit flowing, especially to systemically important institutions. Alongside the Fed, the U.S. Treasury steps in with its own toolkit. Using instruments like the Exchange Stabilization Fund, it coordinates with the Fed to prevent cascading failures across banks, insurers, and essential corporate sectors. Historically, Treasury action has been decisive during periods such as the savings and loan crisis and the Great Financial Crisis, acting as a stabilizing anchor when private capital retreats. But uncertainty around policy responses can amplify volatility. Markets often swing sharply as investors try to interpret ambiguous or evolving signals from policymakers. Statements from Treasury officials, Fed chairs, or congressional leaders can move markets as much as actual interventions, revealing how sensitive the system becomes under stress. As stimulus packages or QE programs roll out, they help slow the deterioration, but the effects arrive with a lag. Meanwhile, bankruptcies begin to rise, typically 6 to 12 months after credit tightens. Small and mid-sized companies, along with sectors most sensitive to refinancing cycles like real estate, retail, and energy, often feel the pressure first. During this turmoil, capital rotates aggressively into safe havens. Treasury bills, gold, and short-term government bonds see inflows, while equities, crypto, and speculative assets experience sharp declines. This flight to safety is a hallmark of every major descent phase since the post-war era. The severity of the downturn correlates strongly with the timing of intervention. Early action tends to limit systemic damage, while delayed responses, as seen in parts of the 19th or in early 2008, can accelerate credit freezes and widen the recession. Retail investors typically react too late. Without access to institutional credit data or interbank liquidity conditions, they rely on delayed indicators and mainstream narratives, often buying dips at the worst moments. Historically, descent phases last between 6 and 18 months, reflecting the time required for deleveraging and asset repricing. Once system-wide stress peaks and policy measures begin to gain traction, the economy transitions into the reset phase, the pivotal turning point where new valuations, new leadership sectors, and the foundation for the next American financial cycle are formed. When the American financial cycle reaches its point of maximum strain, the shift into what economists call the reset phase often arrives quietly, long before the public realizes the worst is over. From a historical perspective, the United States has repeated this pattern for more than a century. A sharp fall, an exhaustion of selling, and then a slow but unmistakable reawakening of liquidity. In every major cycle, from the 1930s to the early 1980s, from 2009 to the post-pandemic rebound, we see the same constellation of signals marking the bottom. Markets are still falling, but the pace slows. Credit stops contracting. The banking system steadies, and the first faint signs of returning liquidity appear, almost like streetlights flickering back on across a storm-hit city. In these moments, valuations hit levels that only emerge once or twice a decade. Price-to-earnings ratios sink into historical bottom zones. Real estate corrects to sustainable levels, and bad debt is flushed out of the financial system. The repricing is often brutal, yet necessary. We've seen entire indexes reshaped as weaker firms disappear, whether during the dot-com crash, the great financial crisis, or the pandemic recession, while blue-chip names return to valuations grounded in fundamentals rather than euphoria. Once assets reset, the early signs of recovery begin to surface in predictable corners of the American economy. Core technology companies, energy producers, and financial institutions are usually the first to rebound, echoing the patterns of 2009 and 2020, while consumer-oriented sectors recover as confidence rebuilds nationwide. The common catalyst behind these turnarounds is always the same: the reintroduction of liquidity. When the Federal Reserve reverses course, cutting rates, halting quantitative tightening, or launching new liquidity facilities, markets respond immediately. Smart money takes the cue, moving back into risk assets long before the headlines turn optimistic. Institutional investors behave differently during this stage than retail traders. Hedge funds and pension funds begin accumulating discounted equities and bonds. Private equity firms hunt for distressed acquisitions, and capital quietly rotates back into sectors oversold during the downturn. This shift typically aligns with what historians of the market call maximum pessimism.
Sentiment indicators hit extreme lows. The VIX stays elevated, and investors convince themselves the worst has yet to come, just as the foundations for the next expansion are forming.
Looking back at cycles such as 1933 to 1936, 1982 to 1985, 2009 to 2011, or even 2020 to 2021, the period following the reset consistently delivers some of the strongest returns in American financial history. Industries restructure. Survivors grow stronger. Innovation accelerates. IPO markets reopen. Private equity deploys capital. And corporate credit becomes healthier than before the crisis. Ultimately, the reset phase is where America's economic DNA reveals itself. A system that cleans out excess, revalues assets, and reallocates capital toward the future. But investors often misjudge these moments, either waiting too long or mistaking failing companies for bargains. History shows that understanding the reset is essential, because this is the moment where new cycles are born and where long-term wealth for those prepared is quietly forged. The unmistakable signs of a new expansion often emerge quietly, long before they register in headlines. As an economic historian, I've seen this pattern recur across American financial history, from the rebound of the early 1930s to the post-war surge of the 1950s, the booming 1980s, and the long climb after 2009. Each phase begins the same way. The fundamentals stop deteriorating and start stabilizing. GDP growth returns to a steady path. Corporate profits recover from recessionary lows, and consumer confidence, which had been battered, slowly rebuilds. These shifts don't create immediate euphoria, but they form the bedrock for the next cycle. One of the defining drivers of every American expansion has been innovation. The United States' ability to turn technological breakthroughs into economic momentum is unmatched. Today, this force appears again. Artificial intelligence, biotechnology, automation, and energy transformation are shaping a new industrial base. Just as semiconductors fueled the 1980s and the internet powered the 1990s, AI and clean energy infrastructure now serve as catalysts for capital investment and productivity gains. History shows that when innovation cycles align with a recovering economy, expansions become both powerful and durable. Corporate America plays its part as well. After any downturn, businesses restructure, cut excess costs, and consolidate. Inefficient firms exit. Resilient ones strengthen. This has happened repeatedly, from post-dot-com tech consolidation to the banking reforms after 2008. A new emphasis on productivity replaces the previous cycle's reliance on leverage. These reorganized firms become the engines of the expansion, attracting institutional and retail capital back into the market. As confidence improves, capital flows shift. Money market funds gradually rotate back into equities and long-duration bonds. ETFs capture renewed interest, especially in sectors tied to innovation and cyclical recovery. Banks, having weathered the stress, loosen lending standards again. Credit becomes more accessible, fueling business expansion and household spending. This revival in lending has historically been one of the clearest signals that a new cycle is underway. Employment follows. Hiring accelerates, unemployment declines, and wages rise. Household balance sheets, often repaired during the deleveraging phase, strengthen further, boosting consumer spending. With improved earnings visibility and friendlier financial conditions, the IPO pipeline reopens, M&A activity increases, and corporations begin expanding into emerging technologies and new markets. Yet every expansion carries blind spots. Inflation can re-emerge if growth overheats. Leverage begins to creep back into corporate and household balance sheets. And public debt continues its long-term climb, presenting risks that don't surface immediately but accumulate over time. Behavioral patterns also reappear. Rising valuations, accelerating margin debt, and a resurgence of speculative excitement in startups and retail trading. These are classic markers of a cycle heating up. Layered on top of domestic dynamics are geopolitical variables: US-China competition, supply chain realignment, regional conflicts, and shifts in the global monetary order. Add to that the unpredictable forces of technological disruption, climate-related stresses, or financial shocks, and the trajectory of the next cycle remains uncertain. Still, the broad shape is familiar. A reset creates the floor. Innovation provides the spark. Capital, credit, and confidence rebuild the foundation. And from that, a new American expansion takes form, powerful, imperfect, and ultimately shaped by the same forces that have guided every major cycle in U.S. history.